They are like us to look at the financial statements or the final accounts. When you say final accounts, these are the statements which are prepared at the end of the year to show the performance of any business organization. So I want us to start from the trading, profit, and loss account. So the trading profit and loss account is also called the income statement, or you can call it the statement of comprehensive income. So it comprises of two statements. The first part is the trading account, and the second part is the profit and loss account. Now let us start with the trading account. Trading account is a financial statement prepared at the end of the year or at the end of the financial accounting year or period in order to determine the gross profit made. It's a financial statement prepared at the end of the accounting period in order to determine the gross profit made during that particular year. So it is prepared at the end of the accounting period in order to determine the gross profit which has been made during that period. Then the profit and loss account is a financial statement prepared at the end of the accounting period to determine the net profit or loss which has been made in that period. So because of that, I would like us to look at the formula of getting those profits. So we have seen we have two types of profits. So we have the gross profit and we have the net profit. So as I said, the trading account is prepared in order to determine the gross profit. And the profit and loss account is prepared to determine the net profit. Okay, so for us to get the gross profit is equal to net sales less cost of those sales. Yes. Pamela, are we together? Pamela? Okay. So for you to get the gross profit, you must get the net sales, then you subtract the cost of sales. Now, how do we get the net profit? Before we go to the net profit, how do we get the net sales? Amira, and unmute yourself. Okay. Unmute yourself. Okay, for us to get the net sales, we must get the total sales, then we raise the returns inwards. We get the total sales, then we raise the return inwards. Return inwards, these are the goods which the customers return after they have bought from you. After buying from the business, then the customers might return some of the goods due to some reasons. Like now, if you sold expired items, or maybe you sold extra or you give them more quantity than which they wanted, then they might return. So you deduct that in order to get the real value of the sales which you took to the market. Okay, now how do we get the cost of sales? How do we get the cost of sales? We get the cost of sales by getting the opening stock, that is the stock at the beginning of the year. Then we add the net purchases, the value of the purchases, then we raise the closing stock. Opening stock, we add net purchases, then we raise closing stock. Now, how do we get the net purchases? Okay, net purchases, you get them from the following formula. You get the total purchases, then we raise the returns outwards. Total purchases minus or less return outwards. Return outwards are the goods which after you are put from the market, then you return to the supplier. Those ones we call them return outwards. Now, how do we get the total purchases? So for us to get the total purchases, it is the purchases, the goods, the cost of the goods which you have bought from the market, then we add the carriage inwards, the transportation cost of the purchased goods. That's what we refer to as carriage inwards. So carriage inwards increases purchases. Return outwards decreases purchases. So for us to get the net purchases, it is the purchases, we add carriage inwards, then we raise return outwards. So because we have worked how we get the net sales and how to get the cost of sales, then you get the net sales, you less the cost of sales for you to get the gross profit. For you to get the gross profit. Okay, when you get the gross profit, then that's the end of the profit. The trading account, the first part of the trading profit and loss account or an income statement. So when you get the gross profit, that's the end of the trading account. Then the profit and loss account will follow. So now we can continue with the profit and loss account so that we determine the net profit. So because you have got the gross profit, for us to get a net profit, it is that gross profit, then we add the trading revenues and we less the trading expenses. Gross profit, add trading revenues, then we less trading expenses. Let us look at the examples of revenues. Examples of revenues. We usually have three which are common. We have the discount received, we have the commission received, and we have the rent received. Those are the trading revenues. The examples of trading expenses. Trading expenses, these are the costs which we incur. So as I said, the trading expenses are those costs which you incur when you are carrying out the business transactions or the business activities. So trading expenses are for only the business, not for your private activities. That's why I'm using the term trading. Okay, so we can look at some of the examples. For example, if you pay rent for the business premises, then that is a cost which you have incurred on behalf of the business. So that is a trading expense. When you are selling goods in the market, then you transport those goods to the customer's premises. That transportation cost of the goods which you have already sold to the customer, that's an expense. That one we call it carriage outwards. Okay. Then we have the commission around. You can have the salespeople, after they have sold, as you agreed, if they sell extra, then you give them a percentage on top of their salaries. That one we call it commission around. Then we have discount around. If a customer buys from you and you want to induce those customers to continue buying from you, you can deduct the amount which you're supposed to pay so that they pay less. That one we call it discount. So that's an expense to the business. Okay. Also, if you do any transaction on behalf of the business, that cost which you incur, it is a trading expense. We have stationery, we can have the postage, we have traveling, transport. So there are so many. So Pamela, can you give me one of the example of expenses, if you know? Pamela, you can unmute yourself.
Yes.
Give me an example of an expense.
Of just clear example of a
expense, trading expenses.
Commission.
Which commission?
Commission.
Remember, there are two kinds of commissions. We have commission received and commission allowed. Which one is an expense?
Commission allowed.
Commission allowed. Okay, for example, if you go to the market to buy goods, the amount which you spend to go to the market, is it a trading expense or it is a private or the private activity expense? You have gone to the market to purchase goods for selling. How do you transfer that? Okay, because you have gone to the market on behalf of the business, then that's a trading expense. That one now we call it traveling, or you can call it transport. Okay? So I said we have stationery. Stationery, these are the consumable goods, the ones which are used for the rust time, like books. We have pens, pencils, staples, those items which are used in the office for the rust time. Remember, the office is there on behalf of the business. So those stationery which is used in the office, that's an expense to the business. So you are not supposed to use your own money to buy stationery. You are supposed to use the business money to buy the stationery because that's the work of the business. You are recording business transactions. Okay. So stationery is one of the expenses, trading expenses. Okay. I think you have understood all the formula which you have said from the trading account. Or you joined us late. Pamela?
Yes.
Do you have a question on the formula which we have discussed?
Actually, hata nimejoin late.
Okay.
Nimeanzia hapo ulikuwa is about the net profit, net profits, purchases.
Okay, it was gross profit.
Then I was trying to settle so that now I can join you.
Okay. I can repeat. So I said,
on that formula.
Yeah, I said income statement is divided into two. So it consists of two parts, whereby the first part is the trading account, and the second part is the profit and loss account. So for us, we are supposed to start the trading account before we move to profit and loss account. So we say the first statement, which is the trading account, we get the gross profit. When we prepare the trading account, it will help us to get the gross profit. So I said for you to get the gross profit, it is the net sales, then you less the cost of sales. The net sales less cost of sales. Net
cost
sales.
Of sales.
Okay, it is net sales, then you less cost of sales. Are you there?
Yes.
Yes. So how do we get those net sales? How can you get the net sales? So the net sales, you get it by deducting returns inwards from the total sales. So it is total sales minus return inwards. Total sales minus return inwards. That's how you get the net sales. Now what are return inwards? What are return inwards?
Total sales and
return inwards.
is it the gross profit and change?
Okay.
Trending
For you to get the, I said for you to get the net sales, it is the total sales less return inwards. So I wanted you to explain what you understand by the term return inwards. Return inwards. Okay, return inwards, it is the cost of the goods which the customers who have already bought from you as a business, the cost of those goods which the customers returns to you as a business. So after selling to the customers, some customers can return some of the goods which you have already sold to them. That's what we refer to as return inwards. So they are coming from the customers to the business. Okay?
Come again.
The goods which the customers return to the business after they have already bought from you.
Customers.
Yeah, the customers are returning to the business.
Oh, yeah.
Okay?
Yes.
Yeah. That's what we mean when we say return inwards. So let us look at the cost of sales. How do we get the cost of sales? Cost of sales? Okay, cost of sales equals to opening stock and net purchases, then you less closing stock. Opening stock, then you add net purchases less closing stock. That's how we get the cost of sales. Now, how do we get the net purchases? Net purchases. Okay, we get net purchases by adding carriage inwards to the total purchases. Also, we raise the return outwards. So it is purchases plus carriage inwards minus return outwards. Have you got it?
Come again.
Purchases. I said net purchases equals to purchases, add carriage inwards, then you less return outwards. Now, what is the carriage inwards? Carriage inwards. What is that? Okay, carriage inwards is the transportation cost of the purchased goods. Transportation cost of purchased goods. After your purchase, the amount which you use to make sure that the goods have been transported from the market to the business premises is what we call carriage inwards. Are we together? Yes. Return outwards is the cost of the goods which the business returns to the supplier. The cost of goods which the business returns back or takes back the supplier. Maybe they are excess or they have been damaged or they are expired. So there are so many reasons why the business can return the goods to the supplier. Those goods, we call them return outwards. So it is a decrease on purchases. Return outwards is a decrease on purchases, and the carriage inwards is an increase in purchases. So even in the trial balance, I say increase in purchases we debit, a decrease we credit. So in the trial balance, carriage inward we debit, return outwards we credit, so that we decrease the amount of purchases. That's how you get the gross profit. So the gross profit equals to net sales minus cost of sales. So do you have a question on that? Before we move on. Okay. So because we have already discussed about the profit and loss account, and we have said how we get the net profit, I would like you to ask questions where you have not understood before we move on, because I wanted us to discuss about the trading profit and loss account and the balance sheet. Do you have questions?
No.
Okay. Do you understand the formats from the clips which I sent to you? Yeah. So we use the vertical format. In the format, we use 3 money columns in most cases because we have more adjustments. The first money column, we write the adjustment for the purchases, and the second one, adjustment for sales, and then the last one, we write the totals. Okay. Okay.
Yes.
Yeah, you can ask a question before we move on.
No, let's continue.
We continue. So you understood about the trading profit and loss account. That's the income statement. Okay. So because of that, I can move on to the balance sheet. Now, how can we define a balance sheet or a statement of financial position? What is the other name for the balance sheet? Can you try to define it?
Balance sheet.
Yes.
Let me use my own ones.
Yeah, you can use your own words.
I think in balance sheet, okay, when you are trying maybe to kufanya hiyo calculations,
Yes.
unafaa upate zote zinakaa the same on both sides.
Yeah. So which items do we use? Okay, the same amount. Between what and what?
Between
can refer on the notes.
Both
Okay.
on credit and debit.
For credit and debit. Okay, for the format, I would like you to look at the format which I've shared. Are you able to see it?
Yeah.
Yes. So in the balance sheet, we don't use nowadays the T format. We use the vertical format. So we don't have debit, we don't have credit. So the format which I've given you here is the simplest, but there is another format. We have three formats for the business, in the business, when you are recording business transactions, any business financial accounts, we use various formats. But now I've given you the simplest, whereby you look at the equity and liability. Equity is the capital, and also we look at the assets. So we have the total assets, which you can also call net assets, and we have the net capital. That is the total equity and the liabilities. The other format, we get the total assets, we raise the total liabilities for us to get the net assets. Then we write financed by, we get the total capital. That is the capital. We have the net profit, then we raise the drawings. Then I have given you the other one where we get the total capital. So when we follow the bookkeeping equation, we say assets equals to capital plus liabilities. That's what we learned under the accounting equations. So we have to get the total assets, that's the non-current assets, we add the current assets for us to get the total assets. Then for us to know where the money came from, we must understand the owner's contribution, that's the equity, and then the other people's contributions, that is the liabilities. We get the total of the two. Now the total of the two should be equal to the total assets. That's what the items which you must make sure that they are equal. So when you look at that format, you can see that the balance, that is the assets, agrees with the total of the owner's equity and the liabilities. Are you able to see?
Yes.
Yes. So we have total assets as 2,160,000. Then we have total equity and liabilities, the same figure. So in that case, you can say that that business is balanced. So when the business is balanced, we call it a stable business. So a balance sheet is that financial statement which is prepared at the end of the year in order to show the financial position of the business or the stability of the business. So this financial position statement is prepared in order to show you the assets, the liabilities, and the owner's equity. So we have only three items in the balance sheet. Only three items: assets, liabilities, and capital. So we have the assets. Before we look at the classifications of assets or the categories, what is an asset?
Something that an entity wants a resource that controls something that is owned.
Yeah. It is something that an entity owns. And an entity is a business. That organization. Anything which belongs to that organization is an asset. Anything which the business has control over, that is an asset. Okay? So the assets are categorized into two. We have the current assets and we have the non-current assets. So I've shared the notes. We have the current assets, those assets which are expected to provide economic benefit in the short term. The short term meaning within 1 year. Within 1 year. Those are current assets. Then we have the non-current assets, the ones which have a long useful life, and they are expected to provide future economic benefits for the entity over a period of several years. So when we say several years, it's more than 1 year. Okay. And also the liabilities are also classified into two. We have the current and non-current. The current liabilities, in other words, you can say these are the debts which are expected to be settled within 1 year. Any debt which you have to settle within 1 year. It can be even 1 month, but it should not go beyond 12 months. This should be within 12 months. That's a current liability. We have non-current liabilities, which you also call them long-term liabilities. They are supposed to be payable within the next 12 months. So it is beyond 1 month. You can pay them beyond 1 month. Those are long-term liabilities. Also, we call them non-current liabilities. Then we have the equity, which is the capital. This is the amount which is contributed by the owner or owners. So they belong to the owner. It is not for the business, it is for the owner. So these are debts which have been given to the business by the owner of the business. In other terms, we call the capital or equity, we call it owner's contribution. And it is a special liability to the business because the business has to pay the owner at the end of the period. The owner has to take his money or our money from the business before paying to the other parties or paying for the other liabilities. Whenever you want to close the business, you have to take your money first, then you pay your debtors. Okay. So for us to get the total assets, we said you must get the total current assets, total fixed assets, and then you add the totals, the two totals. So total fixed assets plus the current assets plus total current assets, you get the total assets. Then the equity plus the total liabilities, you get the total equity. That total equity must be equal to the total assets for a stable business. So do you have a question on the balance sheet where you have not understood? So I've said we use the FATCO format. FATCO format, never use the T format. It is not recommendable. Yeah.
So the question is, so it's not a must to get the same figures on both sides, that is the assets.
Okay. It's not a must. It means you are given figures for the assets, you are being given figures for the liabilities and also capital. In some cases, you cannot be given the capital. It is for you to calculate. You get the total assets, then you raise the liabilities for you to get capital. So you can use the equations which we run for you to get the missing figure. But make sure after preparing the balance sheet, the total assets and the total equity and liabilities are the same. If you are using the first format, as I've said. Okay, so we call them total net assets, is the total assets, then must be equal to total equity plus liabilities. For you to get the total equity, I said, it is the capital which you have contributed, then you add the net profit from the income statement, you less the drawings for you to get the total equity. So what are drawings? Drawings. Pamela, what is drawings? Drawings. Okay, these are the goods or cash. The goods or cash which have been taken by the owner of the business for private use or for personal use. If you take the goods for you to use in your house, it's not in the business, then those are drawings. If you take some amount of money from the business for you to use in your with your family, then that is drawings. Even if you take some amount to pay school fees, you have taken from the business to pay school fees. Remember, school fees is for the personal. It is for personal expenses. So that was not for the business. That's drawings now. So any amount or goods taken by the proprietor, that is the owner of the business, from the business for personal use, those are drawings. So that's a decrease in your capital. You are the owner of the business. You are the contributor of all the assets which have been used in the business, or for the amount which is being used in the business, and you have taken some amount of money from there, then it means you are decreasing your capital. That's why we deduct drawings from the capital for us to get the net capital or equity. Do you have any question? Can you see our time is running off? Are you okay?
I was asking,
Yes.
This balance sheet is quite different from trial balance.
Yes. Trial balance is just a list of all items, all of them. That's a trial balance. You list everything, even expenses, revenues, assets, liabilities, capital, all of them, they are in the trial balance. But the balance sheet, we use only 3 items. We use assets, liabilities, and the capital.
And now on case of trial balance, so
Yes.
it's a must you get the same amount on debit and credit.
Yes. For the trial balance, debit and credit totals must be equal. If one, the entries which have been made in the ledger have been accurately made. Also, if you have followed the rule of double entry. Okay?
Yes.
Yeah, if you have followed the rule of double entry, meaning you write the right debit, make the right credit entry. Like now, if you have purchases, you are supposed to debit. I said if there is increase in purchases, like now carry it inwards, you debit the trial balance. Then if there is any decrease, that is now the return outwards, you credit. So if you credit that return outwards, then you debited carriage in words and the practices, then that trial balance with balance. So you make the right entry. Okay. So trial
Yes.
balance, you write all the items which have been given, all the transactions in the right manner. Yeah.
Yes.
Do you have another question?
No.
So if I give you a question, you can do it.
Yes. I
Okay.
just leave it as an assignment.
Yeah. So I will give you one assignment, then you do it tomorrow.
Yeah.
Yeah.
Yes.
I will give you. So I think you don't have any question from the start, because next time our Zoom we are going to look at the cash book. Okay.
Yes.
Yeah. Make sure you write all the
Yes.
notes. Write all the formats which I've given you through the video. Then you ask questions.
Yes.
Yeah.
Okay.
So let us meet next time.
Okay.
Okay. Welcome.
Thank you. Have a nice day.
Likewise.